So I think hopefully all of you can see. I think we discussed two key ratios, remember, for measure the liquidity, which came as a result of problems the banks faced during the 2007-8 period global financial crisis. So where the Basel Committee introduced two key ratios. One is liquidity coverage ratio. The other one is net stable funding ratio. So each one has different objective. If you look at the liquidity coverage ratio, what is the objective? How do you compute it? Which we discussed last time. Liquidity coverage ratio. Anyone? Can someone tell what is the purpose? Two ratios, liquidity coverage ratio and net stable funding ratio. What is the purpose of liquidity coverage ratio? What is the definition? And how it applies in Sri Lanka? Can someone tell what we discussed last time? Any thoughts, views? What is the objective of LCR? No idea? This is what we discussed last time. Can you ask Eurasha? Are you there or no? So what is the purpose of liquidity coverage ratio? How it is computed? What are the key components of liquid coverage ratio? LCR. No one? So if you look at liquidity coverage ratio, the objective is to survive within a 30-day period. So the sole objective is a 30-day period. So that's why one component of the ratio itself is a net cash outflows that will take place during the next 30-day period. So for you to survive within the next 30 days, okay? So you should have sufficient high quality liquid assets, right? High quality liquid assets, okay? So if you look at LCR, is a ratio where high quality liquid assets divided by net cash outflows during the next 30-day period. Okay? So that is the objective. So what do you mean by high quality liquid assets? Can someone tell? I think some of you were there in the lecture last time. What are the key qualities?
Can be easily and immediately converted into cash or without loss of value.
Without significant loss or with minimum loss.
Yes.
Okay.
And can be readily sold without any collateral income, collateral or lien situations.
Yeah. Okay. So basically, the ability to convert into cash with minimum loss, unencumbered, and ability to keep it as a collateral and take cash either way. Even if you don't want to cash it, but you can keep it as a collateral and get cash. Okay. So that is the objective. Then the high quality liquid assets divided into three components. Yuresha, can you tell what are those? broadly two categories. Within the second category, again, two subdivisions.
That's level 1 assets and level 2 assets. And
level 1, level 2. Within level 2, there are again
2A and
2A and 2B. 2B, yes. Level 1, level 2. Within 2A and 2B, right? So also some the weights given, how much each asset can comprise within your calculation. Now, if it is level 1 asset, how much you can take as high quality liquid asset?
100%.
Huh?
100%?
100%, yes. 100%. 100% you can take if it's a level 1 asset. If it's a level 2 asset, 85%. How much you can take?
Level 2A 85% and 2B 50%.
Yes, 50%. So there are, and also within the calculation itself, there are some limitations, like from the overall liquid, high quality liquid asset, level 2 asset cannot increase more than 40%. And 2B asset cannot increase more than 15%. So there are some internal definition. But broadly, what you need to know is the purpose of the LCR. So what I mean by high quality liquid asset, what are the characteristics of high quality liquid assets, and how do you compute the net cash outflows? Again, different outflow and outflow factors given, because that is outflow minus inflow subject to a inflow is maximum 75% of the outflow which you can take, so that you should be able to compute your LCR at any given time, right? Okay, so NSFR, the second ratio which Basel introduced, okay, second ratio the Basel introduced. Okay. Can you see that? Okay. Okay. So the NSFR is going beyond 30-day period. Now, when you survive for 30-day period, then the bank need to ensure your. Can you see this? Can't. I can't see you.
Sir.
Yeah. Can you see this? Can you see the presentation? So let me move on to the Basel III, the second ratio, that is net stable funding ratio, which is basically once you survive for 30-day period, which is ensured by the LCR. So you are comfortably comply with LCR means you can survive up to 30 days. But that is not sufficient from a bank point of view when you subject to serious stress. Because both these ratios are there for bank to meet the liquidity in a serious stress situation. It's not the normal situation. Normal situation, there are many other ratios. You keep liquid asset, you can manage. But in a stress, it's quite different. If you look at the overall objective, of the two ratios to meet any or to ensure the bank has sufficient liquidity in a stress scenario, right? So let's move on to the NSFR, which basically tells about so if you look at the background, in 2010, Basel Committee on Banking Supervision published principles which we discussed. So these are the two ratios, liquidity coverage ratio and the net stable funding ratio, which came into effect in 2013 and 2014. But in Sri Lankan context, we adopted phase by phase. But now both are in full implementation. Okay, now both are in full implementation. So the objective, if you look at the require banks to maintain a stable funding profile in relation to the composition of their assets and off-balance sheet activities. To ensure banks maintain a stable funding so that they can meet whatever their needs, arising from assets and off-balance sheet activities. And also, it will reduce the likelihood that disruption to a bank's regular sources of funding will erode its liquidity position. Okay, so that ensures there won't be any disruption to regular sources of funding will erode its liquidity position. And also limits over-reliance on short-term wholesale funding. Now, again, going beyond 1 month, ensure that, the over-reliance, because banks tend to use more short-term funding. Okay, so generally it is the nature to have more short-term funding, so that so it reduces banks' requirement for short-term funding, so that banks should diversify its funding base more over long-term, medium to long-term. So definition, I think we discussed already the amount of available stable funding relative to the required stable funding. So it's a ratio between ASF, available stable funding, versus RSF, required stable funding. Of course, here in Sri Lanka, where the direction number 8 of 2018 governs the implementation of this particular ratio. Okay, so NSFR is available amount of stable funding divided by required amount of stable funding multiplied by 100. Minimum NSFR requirement, now it is fully implemented. So that's why the effective date, 1st of January 2019, it was only 90%. Now it is 100% applicable, which is applicable from 1/7/2019. Of course, during the as a result of COVID outbreak, and to ensure the banks need some liquidity, the extraordinary regulatory measures has been taken, so that from 5th May last year, that is 2020, the requirement has been brought down to 90% up to 30th June this year. Okay, because to provide some liquidity space, give some space for banks for liquidity purpose, as a result of many consequences and non-prepayment of loans by the customers and so on, so that this was given, but now it is no longer applicable. Disclosure requirements, if you look at Basel, we will discuss little in the last parts of our course about this Basel III disclosure requirements and capital adequacy implementation, where basically you, under Pillar 3, banks are supposed to disclose certain things for the public, the broader public. Okay, so there are the NSFR and the minimum requirement for the reporting period and previous reporting period must be disclosed. That is for the current period as well as previous reporting period must be disclosed quarterly in the press and website. So every bank must disclose this every quarter in the press and also the website. Annually in the press, annual report and the website. So in addition to the press and web, when it published the annual number, it should be published in the annual report which the bank is submitting or publishing as well. So details of mains component for the reporting period and previous reporting period. That is details. If you look at the, in addition to the ratio, the details must be published in the website quarterly, so that no need to publish in the details to be published in the press. And also annually, details must be published in the website and the annual report. So basically, detail one only in the website and the annual report quarterly and annually. So when you say available stable funding, the available stable funding means portion of capital and liabilities expected to be reliable over the time horizon of 1 year. So the funding, that is the capital. There are two parts of funding in any banking institution. That is, one is the funding coming from the capital, that is owner's money, and funding coming out of the liabilities. So basically, the assets which funded through the capital and assets which funded through the liabilities. So we are basically, for this purpose, we look at the funding coming from these two sources over a time period of 1 year. Okay. So ASF is measured according to the relative stability of an institution's funding, including the contractual maturity of its liabilities. Okay. So ASF measure according to the relative stability. How stable the funding are. Now, if you look at capital, what is the stability? In an institution, from a stability perspective, okay, what is the level of stability of capital? Can anyone tell? What is the level of funding? Stability of funding, if you take a capital. I mean, you all are bankers. I mean, what is the level of stability of capital?
100%?
Yeah, basically very high, because capital is the most stable, isn't it? Because there is capital, you don't have to repay. The funds are there forever, unless the capital is eroded to whatever losses or whatever reason, it is almost 100%. I mean, it is the stability means how long it is lying as a source, because capital you are not going to repay. So the funding is almost 100%. I mean, the stability is 100%. Okay, stability is 100%. Okay. So likewise, the objective is, one is the stability of the funding, contractual maturity. So what is the contractual maturity of the funding source? So now when you take 1 year period, definitely anything above 1 year period is basically stable. Anything below 1 year period, you need some money, because those are not stable, right? So any money, any liability, any funding by way of a liability which is expanding beyond 1 year is definitely stable. And also depending on the different types of funding providers. Again, depending on the funding provider, also, the stability depends, right? For example, if it is a, sometimes wholesale, or whatever private funding, then stability is not that much compared to bank funding, right? So, okay. So, based on the degree of stability, there are factors given. Like, remember when we discussed the cash inflow and outflow computation of the LCR, we gave a factor. Okay, how much inflows coming, how much outflows going out, and percentage, right? So here also there are 4 factors given: 100, 90, 50, and 0, right? So liabilities and capital assigned a 100% ASF factor, right? So the total regulatory capital before capital deduction, excluding tier 2 instrument, because tier 2 is mostly, external subordinated liabilities. So other than those, all regulatory capital is generally considered as 100% available now, because that is the most stable. So availability factor is 100. So if we have 500 million capital in your bank, regulatory capital, before deductions, but excluding tier 2 instrument, you can consider that entire 500 million is available stable funding. So that is 100% available. Any other capital instrument with effective residual maturities of 1 year or more, okay? Any other capital, so other than regulatory capital, there may be other capital instrument, but with the effective residual maturities of 1 year or more, okay? Then again, you can consider as 100% stable, right? The regulatory capital, other capital with 1 year or more can be taken. Then again, secured and unsecured borrowings and liabilities with effective residual maturities of 1 year more. So it go beyond capital now to the borrowings, whether it's secured or unsecured, but maturity more than 1 year, right? Again, considered as stable. So for example, time deposits over 1 year maturity. So if you take in your balance sheet, if there is a time deposit maturing in 3 years, that is a 100% available stable funding source, okay? So but there are some conditions like no legal right to withdraw deposit within 1 year. Only if early withdrawals result in a significant penalty on capital, okay, greater than loss of the interest, okay? If not, entire deposit considered as like demand deposit. So just an elaboration now, for example, these are the, if your bank has any values, how you consider as, factor it into the computation. If you have the regulatory capital, so you can take the entire amount as available, and any other capital instrument you can take 100%, so and so on, so that you can take what you call for your computation depending on this nature. So second category is the 90% factor. Again, non-maturity. Now, demand deposits and term deposit with residual maturity of less than 1 year. Okay. Non-maturity demand deposit, that is non-maturity deposits. So there is no maturity. Term deposit with residual maturity of less than 1 year provided by retail customers and SMEs. Okay. So that's not corporate, right? Retail and small enterprises, usually less than 1 year, okay, counts for 90%. Because assuming 10% is not available, so 90% can be taken as what you call available. Now, if a bank has 100 million such deposits, then probably 90 million can be taken as available stable funding. Then for the SMA deposits, there are some criteria given by our regulator. There should be total amount should be less than 250 million, annual turnover less than 750 million, and bank needs to adopt an internal mechanism approved by the board to verify the annual turnover. So, in order for the bank to qualify for inclusion of such liabilities, there must be there is this criteria that the bank should comply. So, if you look at the customers' deposits, non-maturity with less than 1 year, so you can take 90%. So, if you have 2 million, 2 billion deposit, you can take 1.8 billion as the eligible amount. then these liabilities are assigned 50% of ASF factor. So what are those liabilities? Funding with residual maturity of less than 1 year by non-financial corporate. Okay, so if there are funding but with maturity less than 1 year by non-financial corporate, okay, you can take 50% as ASF, only 50%. So if you have such funding or such deposits, so that you can, let's say 100 million, you can take 50 million as ASF. Not all, right? The operational deposits, example, collection account, escrow account, etc. The funding with residual maturity of less than 1 year from sovereigns, public sector entities, and multilateral development banks, for example. Other funding with residual maturity between 6 months to 1 year, including funding provided by central bank and financial. So, which gives an elaboration about what are the assets you can take. What are the funding sources you can take for ASF purposes. Okay. So if it is 50%, you can take only 50% of the value stated of such elements, right? So that is what has been given. Then there are certain liabilities giving 100%. So that means these are not available. You can't consider them as available for the computation, because these are the factors which are highly vulnerable. Okay. So these are the funding sources. Okay. So that means if you have any such funding sources, any amount cannot be taken as available. So all other liabilities and equity categories, including funding with residual maturity of less than 6 months from central bank and financial institutions. Okay. So anything, all the other liabilities, including funding with residual maturity of less than 6 months from central bank. So anything less than, even from central bank, financial institution, any liability is not considered as available, just zero. So other liabilities with our stated maturity, NSFR, derivatives, net NSR. So these are elements which you cannot take as available. 0% means you cannot take. If you see any of these items in your balance sheet, you will need to consider these are not available because it's 0% factor. Then derivative liabilities also, the direction specify what things you can take, So the derivative liability is calculated by taking the replacement cost for derivative contracts, right? Where the contract has a negative value. To arrive at the NSFR derivative liability, the collateral posted in the form of variation margin must be deducted. So it's a little bit technical stuff. So you need not to know, but broadly it says how much derivative liabilities you can take for the computation. Okay. So these are liabilities assigned 0% factor, including this derivative liabilities. So basically, if you have these type of liabilities for the funding sources, you cannot take them for purpose of ASF calculation because those are zero ASF factor. Okay, any questions so far? No? Okay, so let's move on to the balance part of the equation, that is required stable funding. Now, function of liquidity characteristics, residual maturities of various assets held by and those of its off balance sheet exposed. So basically now, and the available stable funding, our focus was on liabilities, the capital and liability. But here, required stable funding, our focus is on the asset side. Okay, so that is basically depending on the liquidity. So the assets and off-balance sheet exposures are weighted according to the liquidity value. So that unencumbered, shorter term, and high liquid assets receive lower weight. So now, when you look at ASF, stable longer maturity are getting a 100% rate. Now, when it comes to the RSF, high liquid, unencumbered, shorter maturity assets get a 0 RS, because you don't need to maintain liquidity for such assets because these are already liquid. So that's why those such assets get a lower weight. If you take cash, so that's a very high quality liquid asset. So definitely the required stable funding is 0, right? So whereas more long-term stable funding, available stable funding get 100%. Is the opposite. So here, if a particular asset has less liquid, then you get a 100% weight. So they are funding maturity, stability 100%. Here, less liquidity, longer maturity get 100%, right? So there are about 8 RSF factors. So each asset can assign 0, 5, 10, 15, 50, 65, 85, 100% as the factor depending on the nature. So earlier in the available stable funding, only 4 factors. Remember? Under 90, 50, 0, right? Now, more than that, 0, 0, 5, 10, 15, 50, 65, 85, and 100, right? So I think we discussed about the unencumbered asset definition last time. Now here, again, a definition is given as per the regulations. What do you mean by unencumbered assets? Assets that are free of legal, regulatory, contractual, or other restriction on the ability of the bank to liquidate, sell, transfer, assign. So it's free of any impediments. And it gives the ability to liquidate, sell, transfer, assign. You can't do it. Even a liquid asset may not become a liquid. I mean, if even the asset has a nature of liquidity, it will not be an unencumbered asset. Now, can you give example? High quality liquid asset, but not, their liquidity is not there because of encumbered. Can you give example? Can someone give example? Okay, so can you all see now?
Yes, sir. Yes.
Okay. So can you give example of such asset? Nature is very highly liquid, but you cannot consider for this purpose because of its encumbered. Take example of a government security, treasury bill, treasury bond, but you have kept it as a security and taken a loan, but still assets in your book, isn't it? So the asset itself liquid, but you cannot consider for this purpose because it's not free asset, because you have already taken some money against that. Okay. So there is a restriction of asset selling, liquidating, or assigning to somebody else, right? So encumbered assets are encumbered for 1 year or more, receive 100% required stable funding. If you have a such asset more than 1 year encumbrance, then definitely it's a 100%, because liquidity, you don't have any liquidity, right? So it's a 100% RSF. So assets encumbered for a period of 6 months to 1 year, if unencumbered, receive a factor over or equal to 50%. Assets encumbered with a period of 6 months to less than 1 year would, if unencumbered, receive a RSF higher than 50%, retain that higher RSF, right? So there are some definitions, I mean, just explain for your purpose, how the direction allows to take assets as different risk factors, different required stable. Now, if you look at 0% cash, SRR including excess SSR, right? All claims on central bank with residual maturities of less than 6 months. Okay, so you don't have to keep any funding. So 0 means no need for funding, required stable funding. So you need 0 funding, right? Okay. Then if those are 0%, basically that means required stable funding is 0. Then 5% risk factor. So the direction classify what are the assets which require 5% stable funding. Again, these are also partly somewhat higher liquidity assets with a shorter maturity. That's why they need a lower risk stable funding, right? So all are unencumbered level assets qualifying market risk security with 0% risk weight and satisfy all of the following conditions. Any marketable security qualifies for 0% risk weight. Remember, in the credit risk component, credit risk calculation itself, there are 0% different risk weight for credit risk purpose. Any such marketable security, but should satisfy these requirements, then you can consider only 5%. That means, again, so basically, now these assets must satisfy now traded in an active and large market. Okay, so I mean, even though they are 0% risk weighted, marketable, so idea is you must be able to liquidate in an urgency. So in order to liquidate, you must have active and large market. Not an obligation of a financial institution, no, it's affiliated, not an obligation. At the mark-to-market value, proven record as a reliable source of liquidity in the market even during stress market. Now, even the good assets do not have any liquidity in a stress condition. But you must ensure, even in a stress condition, you can liquidate. Then 20% of derivative liabilities, right? Qualifying marketable securities. Okay. So what do you mean by qualifying marketable securities? The qualifying market security means issued by sovereigns, or that is either government of Sri Lanka or external, which are traded in exchange. Guaranteed by sovereigns, any instrument security guaranteed by central bank or the government of Sri Lanka or foreign sovereign with a credit rating this month. Issued though guaranteed by central banks, either IBSL or foreign central bank. Issued though guaranteed by Bank of International Settlement, IMF, European Central Bank, multilateral development banks, etc. So these are the conditions which you can consider. You should consider when you consider qualifying marketable securities. If those assets are there, you will assign a factor of 5% because you need only 5% required stable funding is only 5%. So then there are other assets which assign a 10% factor. Again, if you look at definition, unencumbered loans to financial issue with residual maturity of less than 6 months, where the loan is secured against level 1 assets and where the bank has the ability to freely rehypothecate the received collateral. So there are different definitions. So in such a case, you will only need 10% funding, right? Then 15%. So I'm not going to again discuss each and every one. So the direction clearly gives what assets in your balance sheet qualify for 0, 5, 10, 15, 50, 85, whatever, as per the direction, right? These are the 15%. So if it is 15%, you can take 15% as the required. So lower the risk weight, okay, lower the RSA factor, that means you need to maintain only lesser funding, okay, lesser funding. Higher the risk weight, you need to maintain higher fund, right? In 50, 50, and 65, if you take 65, unencumbered residential mortgages with a residual maturity of 1 year or more, right? So if you have unencumbered residential mortgage with a residual maturity of 1 year more, so that it means you have granted loans against mortgages, the 65% is the factor. So you can assume 65% is funding required. So you need to ensure funding of 65%. So other unencumbered loans, excluding loans to financial institutions with a residual maturity of 1 year more and a risk weight of lower than 50%. Okay. Again, funding requirement is 65%, right? Then 85% per assets posted as initial margin for derivative contracts. Okay, so if you have any assets posted as initial margin for derivative contracts, then those are 85% risk factor. So again, it gives different elements which you can you need this much of funding. So 85% means a lot. So when you have those assets in the balance sheet, you need to have more stable funding. Percentage higher means you need to have more and more stable funding. Okay. Then 100%. Assets encumbered for a period of 1 year more, 100%. If you have such encumbered asset, you need 1-for-1 matching, that is 100%. NSFR derivative asset, net of NSFR derivative liability. So these are the assets you can you need to maintain 100% of the stable funding, right? Okay. So again, so other than assets in the balance sheet, for the off-balance sheet items also, different RSF factors have been assigned. Now, for example, undrawn committed credit and liquidity facilities, so there's a 5% RSF factor. So anything undrawn credit and liquidity facilities in the off-balance sheet, the bank has to ensure 5% stable funding is required, right? Unconditionally recoverable credit and liquidity facilities, okay, only 0%. So that means you don't have to maintain stable funding for such off-balance sheet items. Obligations to trade finance, you have to ensure 5%. Okay, funding is required. Obligation unrelated to trade finance, 0%. Any other obligations, 5% RSF. So again, with respect to the off-balance sheet items, you can decide how much you need to maintain as funding for such assets. So here again, example, depending on the nature, how much funding is required. Okay, so if it is, for example, unconditional revocable credit and liquidity facilities, you need not have any funding, so 0%. But if you look at trade finance related obligations, then you need to maintain 5%. And so this is about our, what we discussed, the calculation. So don't worry about it. Total, if you go back to the slides, which we had the numbers. So the total available stable funding, if you add them, is this much. The required stable funding is this much. So the NSFR, required stable funding for off balance sheet and on balance sheet differently given. So the total required stable funding is 2003. So that the available stable fund is 2429. The NSFR is the total available stable funding divided by total required stable funding, which comes to 180. So that means if the bank maintains above 100%, you are comfortable in terms of liquidity under a stress scenario. So you have the greater ability to meet or sustain in terms of liquidity in a stress situation, right? Okay. Any questions? Anything? No? Okay. You are comfortable. So let's move on to quickly a few slides on the broader concept of ALM. Then we will discuss a couple of questions on the areas I have covered, on this market risk and liquidity. So let's look at ALM function. Now, what do you mean by ALM? Asset liability management. Defined as a mechanism to address the risk faced by a bank due to the mismatch between asset and liability. This is the natural reason we need to manage asset and liabilities in an effective manner in a bank, as opposed to any other institution, because of the mismatch. So, an effective asset and liability management techniques aims to manage the volume, mix, maturity, rate sensitivity, quality, and liquidity of assets and liability as a whole, so as to attain a predetermined acceptable risk-reward ratio. So, when you talk about asset and liability management itself, there are many factors, many components of it. Managing what? You have to manage the volumes, different volumes of assets and liabilities. Mix, different mixes. How much short term, how much long term. Okay, within particular asset category, how much retail, how much wholesale, and so on. The maturity. Okay, how much you need to have 1 year and less, how much you need to have 2 years and less, and so on the both sides. Rate sensitivity, again important. What is the nature of sensitivity you are? Is it variable? You track for variable assets, or variable liabilities, or fixed assets, or fixed liabilities, depending on the sensitivity. Quality. Okay, quality of the assets and liabilities. Okay, and liquidity of assets and liabilities as a whole, so as to attain a predetermined acceptable risk reward. Because at the end of the day, while you maintain liquidity, you need to ensure sufficient reward also, return also. On one hand, you manage the risk. On the other hand, you forego return. But you need to ensure you achieve both simultaneously. While managing liquidity at a comfortable level, you need to ensure you get a good return as well. So that's the task of ALM. Okay. So it is aimed to stabilize short-term profits, long-term earnings, and long-term substance. Okay. So the different the broad parameters, if you look at overall perspective, it's net interest income, net interest margin, market value of net worth of the bank, right? So your focus is on 3 parameters: net interest income. Everybody would ask, the director board would ask, how much net interest? How much? What is my margin? So while doing all this ALM function, You need to manage these items and market value of the network. So at the end of the day, you need to ensure the minimum disturbance to your network or the value of your network. Okay? Because that is the bottom line. Okay. So due to whatever the interest rate movement, whatever the structures, ultimately your net interest income will be affected. And as a result, margin will be affected. On the one hand, and as a result of fluctuation of values, your market value of the network will be affected. So the board should have overall responsibilities and should set the limit for liquidity, interest rate, foreign exchange, and equity price. So any organization, any bank, the board have the overall responsibility, and they basically, what you call assigned to the CEO and the rest of the team to carry out in operational level. Okay. So the ALCO is Asset and Liability Committee, which is a very important committee from a bank perspective when it comes to managing risk and liquidity and overall financial condition of the bank. So ALCO decision making unit responsible for balance sheet planning from risk return perspective. Okay. Monitoring the market risk levels by ensuring adherence to the various risks. So they need to monitor the market risk levels by ensuring adherence to the various risk limits set by the bank, right? Articulating the current interest rate view and a view on future direction. So this, because one of the key components on this whole exercise is the view of interest rate. So the only, because ultimately your NIM, net interest income, net interest margin, and ultimately the value, profitability value depends on the interest rate directions, mainly from a bank's perspective. So you need to have a view, current and future, so that you can factor them in your ALM function. So you must decide the business strategy of the bank consistent with the interest rate view, budget, and predetermined risk management objectives. So there are many aspects you need to take into account as the. So you have to design the right mix of assets and liabilities under different asset classes. That all depends on the business strategy of the bank, consistent with the interest rate view, budget, and predetermined risk objectives, risk management objectives. So the determining the desired maturity profile and mix of assets and liabilities. Again, you have to determine the desired maturity profile. Okay, what is the right structure for me? Because you have to look at many other factors as well. If you look at the previous item, okay, you simply alone can't decide only by looking at the maturity. So many factors. Then product pricing for both assets and liability side. Now, depending on your desired maturity profile, then you have to price the products. Assets and liability, because that itself have significant impact on your ALM function and ultimately net interest income and the net interest margins. So deciding the funding strategy. So how you are going to fund? Remember, now in terms of liquidity, we looked at two sources of liquidity from a bank perspective. Two strategies. What are those two strategies? Can someone remember last week? Two strategies. I mean, different depending on the bank's, interest, they can follow either one or both mix. Remember, asset and liability management, purchase liquidity, and stored liquidity. Stored liquidity means asset side. So you maintain sufficient asset. So that is stored liquidity. Or purchase liquidity, that you depending on the funding whenever you need some liquidity. Remember last week we discussed. So based on such strategy, let's say if you are basing on funding strategy, then what is the source and mix of liabilities or sale of assets? So what are the funding sources and the mix? How much you go for deposit, how much you go for long-term borrowing, whether you move for equity, and how much. And also reviewing implementation of decisions made at the previous meeting. So you need to review decisions made at the previous meeting. So it's basically you cover the currency, foreign exchange risk, liquidity risk, interest rate risk. So broadly, those are the critical components of a ALM risk function. Okay. There are other risks interrelated, but when you take ALM, broadly you have to focus on these three areas: liquidity, the foreign exchange, and the interest rate. That's it. Yeah. So basically, the ALM function covers these three areas, right? Okay. Any questions? Anything you need to discuss? Okay. Shall we, are there any questions? Because we will move on to a few questions on areas, the mathematical calculations to ensure you are comfortable of, calculations. Are there any questions before we move on? Because today I complete my session on these market risk, ALM and on. So probably from next week, so Fernando will take you through the credit and operational risk component. And probably towards the latter part of the course, I will take again on Basel requirements and governance and other whole part of the program. So before that, so I want to see how you are comfortable with your calculations on areas so far we have discussed. Any queries? Okay, so shall we work out a few questions now? This is on historical simulation. I think I have explained in detail the simulation. How do you work out under different models? Okay, so you are comfortable. So today let's look at another couple of questions on those criteria. Okay, you can take down this and you can start working, because we are doing it now from rest of the session is on couple of exercises, right? So if you try or work your own, okay, and try. Otherwise, if you don't try here, you will not try at the exam, right? So you try to do it. If you don't try, means you fail these questions. I don't know other questions, this part, right? So take this down and start working. Take few minutes, but we will discuss once you finish. Okay. So you are the Chief Risk Officer of ABC Fund Management Limited. Your fund managers have decided to invest rupees 200 million in shares of the company XYZ Limited. right? The price of the share of XYZ during past 25 days, trading days, along with respective daily returns are given below. So now you are the fund manager. Sorry, you are the chief risk officer of this particular fund management company, and your fund managers have decided to invest 200 million in shares of XYZ company. So the price of this particular company over the last 25 trading days, along with the return, so you don't have to worry about the return, also given. Okay, so please take this down as we go on. Please take this down. Take the numbers, 25 days, price, and the return. Once you finish take down, please tell me so I can move to the next page, and we can discuss the questions. Then you can start working on it. Once you finish taking down, please tell me.
So we can't see the return of the last figure. Day 20.
Sorry? Sorry?
The return of the last figure. Day 22.
I can't hear you properly. What is that? Return, yeah. What is the question?
So we can see the return of the day 2. Day 22.
You can't see the?
Return of the day 22.
Okay, day 22. Can see now?
Yes, sir. Thank you, sir.
Okay. Have everybody taken this part, because then you have to move to the next page for the other returns. Is that Yuresha, you spoke to me?
Sorry, sir.
Is that you said that can't see? Okay, now you can see the rest of the 3 returns, 23rd, 24th, and 25th days. So you can take that as well. So once you finish taking the returns and the prices, please let me know. You all have to work with me because I need the answer from each and everyone in the group. Because I need to take down each and everyone's answer on the board and discuss. So all of you have to work with me. I mean, work independently, for this particular question, right? So everybody has to provide the answer. Can't just keep quiet. So all of you have to work out the answers, please. Okay. So the first question is, take it down. You are required to compute the maximum possible loss in value to the fund over next 30-day period at 90% confidence level using historical simulation. Use interpolation to work with fraction of numbers. Remember, we discussed historical simulation, interpolation. Remember, we discussed all those during our simulation exercises. Now you have to apply it. The second question is, you are required to compute the maximum possible loss in value to the fund over next 30 days period at 90%, 95% confidence. So first one is 90%, second one is 90%, 95% confidence level using historical simulation model. Use interpolation to work with fraction. Remember, if there is a fraction, you need to work out with interpolation. So very easy, simple question. One is 90% confidence level, the maximum loss percentage. The second one is at 95% confidence level, the maximum loss percentage, that is the value at risk. Over the next 30-day period, Have you all taken down? Anyone who has not taken down the question yet? Anyone who has not taken down? Okay. So now start working on the loss calculation under 90% confidence level and 95% confidence level under the historical simulation. So let's do the first part first, then we will go to the second part. So I want to answer from each and every one. And also fractions, you must use interpolation. You can't take the closest number. Use interpolation to work with fraction of numbers. So once you do the question answer for the first part, please tell me, then we can discuss that and then move on to the next part. Okay, let me ask. So, what is the first thing you need to do? What is the first thing you need to do to answer the two questions? What is the first thing you need to do? You must be doing something, no? So how did you start? How did you start? We'll ask one by one. Can we ask Delicia? How did you start? No answer. Can we ask Udena? How did you start the question? So all of you need to come up with the answer. Otherwise, we really don't know where you are heading. Okay? All of you have to work out. Even you have your notes with you. Doesn't matter even you look at them. Because this is, not the exam. So I want to ensure you are comfortable with the numbers. Right? Suresha, how did you start? Can we hear from you?
Sir, I can't do anything today. I lost my laptop charger due to the high power, so I'm joining from the phone.
Sorry?
Sir, I lost my charger due to the high power, so my battery went off and I'm joining from the phone today.
Okay.
So due to this high power issue that Friday happened, so I lost my charger and I don't have this power to my...
Are you working with no need for laptop?
Okay, sir.
For this question, no need for laptop. If you take down the value, did you took down the values and all those stuff?
Yes, I put down.
So you can work out with them because don't use a laptop. It's a simple, normal, no handout. I mean, A4 sheet you can do.
Okay, so I then try.
Yeah.
So I just
Okay.
got out the.
Okay. Anyone, can we ask Udena? How did you start? Can we hear from Mr. Udena Patirage? No answer? Okay, you are there as per this, you know, Felicia? Can you hear from Felicia?
Yes, sir.
Felicia, how did you start?
So 90% confidence means 10% worst case. So we have
It's not, have you done the first part, that is 90% confidence level value at risk? How did we start?
I got the 10% worst cases. So 24 returns out of 10%. I got 2.4.
Which one? 2.4? No, what I am asking you is, how did we start the answer? First thing, what did you do? Because under historical simulation, you have to do a first thing. Then only you can work out. So what is the first thing you did? Without which, if you can show, come on video, you can show the way you did. That's fine. You can come on video. So how did you do the first step? Because to work out, you have to start with something. Remember, go back to your notes and see. Probably you would have done that. I'm just asking you. Sumutu, can you hear from Sumutu? How did you start? Chirukuma? None of you are talking. What has happened? Are you just switch on, online and doing something else? Because after you do only, I can discuss. Because no point I just discuss, because I have done myself several questions. Now I want you to see. I want to see that you all are capable of doing, and then we can discuss the answers. Tirukuma, where did you start? Taraka, where are you? Where did you start? Taraka is missing suddenly. Nalindi, how is it going? Where did you start, Nalindi? Can you hear from you? How did you start? Because if you don't start properly, yeah, Nalindi. Felicia, yeah. Nalindi? No? All of you have to do, otherwise we can't discuss this. Without your answers, I don't know where how did you do? Lakshan, how are you going? Where are you now in the question? Hiroshika? You can refer your note anything, but we need to Kamali. So where are you? I think, are you in the lecture or doing something else? Please tell how did you start, then otherwise we don't know, because probably you may not go in the right direction. This is the whole problem in online classes, as I usually say. Online classes are good for your academics. I can't see you, no response. I don't know what you are doing. Don't we get disappointed at the exam. Please ask if you have any question. We can discuss. If you don't work this alone, then you will not. First thing is you don't understand the problems or the errors you make. So that's why I thought of doing question. A couple of questions on the area, so you are very comfortable if you get something like that in the exams. And these are things you must practice also in your day-to-day working environment. If you work in such area, you know the principles. You may have application packages and so on, but you know the underlying principle. You don't need any laptop, anything for this. Only a A4 sheet is enough. So can we hear from Sumuthu, Dilanga? Not in the class? Rakshan, where did you, how you started? Starting point is very important. If you at the first step, if you don't do the first step, then you can't do the rest of the things. So there is first thing you need to do. Hiroshika, Kamarin Pereira, Kumara, Nalindi, and there is someone. Can we hear from Yuresha again? Unfortunately, I come to disturb you. Yuresha, how did you start? Oh, how do you start?
So we have to with the 95 confidence level, I'm not sure whether I'm correct. So we have to start from that way. That means that we have to take the value which is like the starting point should be like value relevant to the same.
How do you do? What I'm asking is, how do you start with? I know to come, but how do you start with? The first thing you do, you have a couple of data columns, right? One is the price and one is the return. I have given.
Yes.
So how do you start with? What's the next step?
We have to take the price next price point, which is at the confidence level, which exceeds 90%.
What I'm asking, how do you do it? To do that, you have to do something first, no? That's what I am asking all of you.
We have to arrange the return from lowest to high level.
Lower. Okay. Now you are sleeping all this time. Suddenly you are not talking. Yes. Yeah.
Thereafter,
as Sumuthu said, yes. Well, first step is you have to rearrange the returns from lowest to highest in a column, without which you can't move forward, right? So you rearrange the returns from lowest return to the highest one, ascending order. That is the first thing. In historical simulation, the return you arrange from lowest to, because in the historical simulation we are not using any model. right? You are not using any model to estimate. Simply you look at the whatever the prices or whatever, you compute the return. Now here I have given the returns computed for you all. Now usually the exercise we did, we computed the return using the either natural log or log 10. Remember? Simple return or natural return. Sorry, natural log return. And here I have computed return for you all. So the next step, as Sumuthu said, arrange them in a lowest to highest return. Have you all done that? I think Sumuthu has done. What about others? Uresha, have you done that? Without which you can't do anything. If you don't see the returns from lowest to highest, you can't identify the bottom numbers, right? How many of you did that? We'll ask Lalindi, did you do that first? Irukuma, please respond. Otherwise, I don't know whether you did or not. Irukuma, did you do that first?
No, sir. Sorry, sir.
Have you done that part, arranging it?
No, sir. I couldn't join the last 1 or 2 classes, sir.
Unfortunately, I can't hear your voice properly. Now it goes on, but it's okay. But you have to do that first, right? Then Felicia, have you done that? Felicia, where are you now? You're joining from two ends, but no response. Udayana, have you done that one? Did you arrange the returns from lowest to highest? Mr. Udayana, can we hear from you? Hopefully you are not there in the lecture. So Udayana is not there in the lecture. Nilandi, are you? If you are in the lecture, the question is, have you arranged the returns from lowest to the highest? Also not in the lecture. If I don't get a response, that is the simple thing I can assume. Okay, Lakshan.
No, sir. I didn't do that, sir.
Okay, so please arrange the returns from lowest to highest. So that is the first step you have to do. Okay. Okay. Then Kumar. Have you? Nilandi, yes. Nalindi.
No, sir.
Have you had done that arrangement?
No.
Okay, so that's the first thing. Now, all you have never done that. If you look at your notes, this is the first thing we did. Please do it now, because I am not going to do until you complete, because no point I am doing, because I have done enough for you all. Now it's your time. Hiroshika, have you done? Are you there or you are not there? Just switch on the laptop and doing something. Looks like that. Kamaleen, have you put the numbers in a ascending order? Kamaleen is also not there. Binali?
No, no, sir. I didn't arrange.
You have arranged?
No, sir. No.
Okay, so please do that. So all of you must do that first. I think Sumuthu has done. Except Sumuthu, others need to done that. So please do that. You have given the return. In order to do the historical simulation, that is the first thing. This is what we discussed. Okay. Arrange from lowest to highest. You have to do manually, yeah? No Excel sheets, nothing. Don't do it Excel. If you get a question exam, you are not supposed to do an Excel sheet. Manual workout. So you don't have much data points now. Everything is given just to put it in the ascending order in the right another column. Then rest of the thing is very fast. Do it very fast. Okay. So do it and tell me those who are there in the class whether you have done that, so that we can move on. Right? Because at least we have to do the first part before we take up a break. So please do it. So once you finish, please tell me I have finished the arranging that one. you have anything, please ask question. Huh?
So in the exam, when we are doing manually,
Yeah.
So we have to put both the columns. No?
Sorry?
In the exam,
I can't.
in the exam when we are doing.
Yeah.
In the exam when we are doing manually, we have to put both the columns. No, with the. I mean the price. We have to put the price column and the probability column both.
No, return is there. No, you have given the return, right? Now you have to put the return from a lowest to highest. Yeah.
Yeah. So only that has to be done.
When you do in Excel sheet, you did it using the function. Now here,
yes,
you rearrange the return, okay, in a separate column, which is the starting from the lowest return. Okay, tell me what is the lowest return in this series?
51 to 94 it goes. The lowest is 51 and the
what is the lowest return? Lowest return.
51.
Minus 0.33.
Return, yeah, minus
0.33.
Yes.
Anyone, any other return less than that? Sumutu, I think, have you done? What is the lowest return?
Minus 40. 40%.
Minus 40. The lowest return is 40. Go through this. What is the lowest return? Minus 40.
Yes, sir. Excellent.
Minus 40. If you look at the 14 under the item number 14, day 14,
all right.
Minus 40 is the lowest. Now rearrange that starting from that. What is the next lowest? What is the next lowest? Until the highest one. So when you have that column, rest of the part is very easy. You have to identify if it is 90% confidence level, what is your target? If it is 90% confidence level, what is your target? Which lowest return you look at?
5%?
No, 90%. I'm asking 90%.
So then it's 10%, sir.
10%, lowest 10%, 10% return. So here 10% means how many returns you have?
24.
24. So that means which return you look for?
2.4.
2.4, right. So you don't have any 2.4, no? So you have second return, third return. So how do you get the 2.4? Interpolation. Second return plus fraction of second and third. Remember we did the interpolation calculation for historical simulation. That is your 90% confidence level return, right? So please rearrange, the numbers. Then we can discuss that whether you got it right. Okay. So have you done, all of you rearrange?
No, sir, still doing that.
Okay. Please do, and then we will discuss.
Done, sir.
Elisha, have you done?
Yes, sir.
Okay. Yuresha, how about you? Still working out?
I'm okay, sir.
Done.
Yes, sir.
Lalindi? Lalindi? Can we hear from Lalindi? Lakshan?
Done, sir.
You are done, huh?
Yes.
Okay. Kumara? Have you done? Mr. Patriki? Hiroshika? Have you done? Kamaleen? Kamaleen? Have you done? Binali?
Yes, sir.
Okay, okay. So let me show you on the board. Can you all see the board?
Yes, sir.
Okay. So when you rearrange the number, you should see minus 40, minus 0.33, minus 0.26, minus 0.25, minus 0.24, again minus 0.24, then minus 0.21, then minus 0.19, then minus 0.13, then minus 0.1, then minus 0.07, minus 0.02, then you have plus positive return 0.04, 0.05, 0.09, 0.10, again 0.10. Can you all see this? Can?
Not clear, sir.
Okay. I'm putting in the small letters. 0.22, 0.39, again 0.39, 0.47, 0.48, 0.7. So this is the returns I have given you. If you rearrange from the lowest to highest, the lowest is 0.40, highest is 0.72. So in a historical simulation workout, this is the first thing you have to do. If you are given a price, first thing you have to do is to compute the return. If you are given the price, you have to compute the return. But here I have computed the return for you to save the time, right? I have computed the return for you. Usually you get the price, no? It's a price. Then you have to compute the return. But here I have done the return for you, daily return for 25 days. Sorry, 25 days prices are there. So you have 24 returns. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, one equity. Oh, sorry, one is here. Okay, so it's this is 24, 23, 22, this is 21. Okay, so this is 2, this is 3, this is 4, this is 5, this is 6, this is 7, this is 8, this is 9, 10, 11, 12, 13, 14, 15, 16, 18, 19, 20, 21. Okay, 22. So there are 24 returns. So have all of you got this one? Returns? All of you, those who did. Unfortunately, others.
Yes, sir.
No one. Okay, those who didn't. Felicia, you got the numbers?
Yes, sir.
Okay. So whoever others, Susan and others. Okay. Now to the, if you go to the first question, is the 90% confidence level, right? That is the first question. Okay, 90% confidence level, right? So 90% confidence level means what?
Percent at risk.
Lowest 10%. Lowest 10%. So lowest 10% means we have 24. What is the item you need to look at?
2 and 3, sir.
Yeah, 2.4th item, 10%, 90% means you have to look for the lowest 10%. The lowest 10% means out of 24, 10% means we have 24 observations, 2.4th item. Okay. 2.4th item. Okay. So have you computed the 2.4th item? That is the value at risk. Have you computed the 2.4th item? Tell me what is the 2.4th item? Okay, so compute the 2.4th item using interpolation and tell me the value at risk now. Okay. Have you come up with the numbers? First part, 90% confidence level. What is the bottom 2.4th return value? Sumutu, have you done? 2.4th return.
Negative 30%.
Negative 30. Okay, if you put another decimal. Negative 302. Right? Negative 302.
Yes.
Negative 30.2%.
30.2%.
Okay. Okay. Now at least what we got one answer. What about Felicia? Have you got the number or still working?
So I got negative 0.29.
Oh, maybe a slight round off error, maybe. Okay.
So I got lowest number 2 and 3 get the average. Is that correct?
Not the average, because you have to take the fraction, no? 0.4%, no? So if you look at 2.4 returns being the lowest second plus
Yeah.
fraction, 0.4 fraction of the difference, right? You got the 0.5.
Yes, I got
Yeah,
it.
that's
I
wrong.
got
Because
it.
you have to get the 0.4, no? 2.4 means 40% fraction.
Yeah.
So if you get that, you must end up with negative 30.2%, right?
Okay, I'll try, sir.
Okay. What about Suresh? Are you doing that? You got the number?
I got the number, sir.
Yeah, negative 302.
Yes, sir. Yes.
Okay. What about others who don't talk? Or missing? Anyone got a number? Okay, so how do you get it? If you look at the returns, I'll put here. Oh, here. You can see here. Okay, okay, now we want to look at the 2.4th return. Now 2.4th returns lies between the second and third. And here, 0.4th item. The second return is negative 0.33. Negative 0.33. Second return plus the third return is minus 0.26, right? Minus fourth return is minus 0.33. Sorry, not for third, right? Into a fraction of 0.4, right? So the second return, negative 0.33 plus the difference of these two returns, minus 0.26 minus 0.33. Fraction is 0.4 because 2.4th return, right? So we end up with minus 0.302. That means minus 30.2%, right? So that is the worst loss that can happen with 95% confidence on a single day. On a single day. Because these are all daily returns. We took 25 prices and 24 daily returns. Now, if you want now, what is the question? Question is what? What is the maximum loss on this particular portfolio over the next
30 days.
30 days.
30 days. So how do you get for the 30 days? Remember the formula. What is the formula? If you know the daily VAR, you can compute for any period. What is that? How do you compute? Go back and look at your notes. Only today, not in the exam. Today, permitted to look at the notes, not in the exam. How do you get the 30-day VAR? Can I write here? Oh, here. 30-day VAR. 30-day VAR. Value at risk. How much? This is the daily VAR. Daily VAR with 90% confidence level. 30-day root 30 into 30.2% into 200 million. Because portfolio is 200 million if you are going to invest. Right? Okay. So you have to compute and see that they were root 30 into 30.2%. So what is the number you get? What is the number you get? How much? I haven't computed that part. How much? Anyone compute it? What is the number? Root 30 into 30.2% into 200 million. Is that right? Check the number. Okay, you can do the second part, 95% confidence. I don't have the formula to see.
I got the answer as 42.56. Is it correct?
What is that?
42.56 million for 30
The,
days more.
for 2.56.
Yes, sir.
Okay, maybe I don't have the calculation, but must be right.
I use the square root formula in Excel.
Okay, that's right.
Okay.
If you use right, that's okay. Because only thing is check the formula for the when you convert daily VAR into the period VAR formula. Okay. Okay. Before we start the next question, please do the final part, historical simulation. What is the 95% confidence historical VAR? %95% confidence is historical VAR. How much? So for the 95%, what is the data point you look at?
1.2.
5%. 5%. So 5% means what is the data point?
1.2.
1.2.
2.
1.2. 1 point second item. So 1 point second item is lies between first and second. The bottom first is minus 0.40. Bottom second is minus 0.33. Right? So if you look at that one, okay, so that is that is lowest 5% means 1 second item, so which lies between the first and second. Here, that is 0.2, 1.2. So the first item is 0.4 plus second item is minus 0.33 minus 0.40 times 0.2. Okay. It comes to how much?
Minus 0.386.
Minus
386.
0.36. So basically, any given day, we are confident that our loss will not exceed 38.6%. That is the maximum loss. Maximum loss over any given day. Right? That is the worst case loss over any given day based on the returns of last 25 days. Right? Based on the returns of last 25 days. So this way you can compute for any confidence level the value at risk. So this is the 95% confidence interval daily value at risk. So 95 confidence level daily value at risk. Okay. So you can compute for your overall portfolio how much in a given day you lose. Maximum loss with 95% confidence. So 95% confidence, you are not losing more than this. So that is the maximum loss. That is, you can lose 38.6% of your portfolio for any given day. So this is basically a very simple exercise on historical simulation. So you should be able to work out. If you are given the price, you can compute the return. Now in this particular question, I have given the returns also. You only had to rearrange this from lowest to highest, right? So rearrange that from lowest to highest and then look for the confidence level. If you are talking about 95%, you would look for the lowest 5%. So if you have 100 observation, lowest 5 is 5th item. If you have 50 observation, lowest 5 is the 2.5 5th item. If you have 20 observation, lowest 5 is the 1st item. So depending on the number of observation you have, look for the lowest number. And if it is a lie between two numbers, take the interpolation. Take the interpolation. If you want to find out the 2.7th item, take the interpolation between second and third. Second plus 0.7 fraction of the difference, right? So you can do for any fraction. If you get an item like that, like 2.9th item, better you can take the third item because 2.9 is very much close to third. But if you are asked to do interpolation, please do it. If you don't ask interpolation, you approximate, if possible, it's very close to the whole number. If it is 2.9th item, you can take the third item. If it is 2.1st item, you can take the second item. If they are much closer, otherwise you have to interpolate anyway. But if the question says interpolate, then do interpolation, right? So that is the first exercise we are going to do. and we did on historical simulation, right? Okay, so we'll stop for a break. We went with this question for quite a long period. So I need a break for about 15 to 20 minutes. Then we will do the next question on repricing gap analysis. Okay? Repricing gap analysis. So you are very comfortable with anything on such area, right? Especially from the question front. Okay, so we'll stop for a small tea break. Okay. Can you all see this? Okay. Can we move on to the next question? Okay. All of you can see the question, huh? Anyone who can't see? Can you see?
So
How
we
many-
can't see the question.
Oh, you can't see, huh? Okay. Let me see. Can you see now?
No, sir.
Okay. So we'll do the second question. This is about the repricing gap calculation. So you have been given a very small balance sheet, statement of financial position of the XYZ bank, and the bank adopts the repricing gap model to measure and manage interest rate risk. So as per the monetary policy statement just announced, that is on 30th/6/2020, by the central bank, the policy rates are going to be revised upwards by 75 basis points. So it is expected that market interest rates are going to be adjusted accordingly by the same amount. Okay. So this is the balance sheet. Okay. This is the balance sheet. The assets, treasury bills 91 days 25, treasury bills 365 days 75, treasury bonds 175. You can take a picture or whatever for your workings.
So still we can't see the question.
You can't see the question. Some
Yes.
set can. Anybody can see.
No, sir.
Okay, let me see. How can it be? Can you? Can you see now?
Yes, sir, we can see now.
Okay.
Right, sir.
So this is about the XYZ bank financial position. The bank adopts repricing gap model for the managed interest rate risk. There is an announcement by the central bank that policy rates are going to be revised upwards 75 basis points. So it is expected that the market interest rates are going to be adjusted accordingly by the same amount. Okay, so there's a revision of 75%, 75 basis point, that is 0.75%, and market interest rate will go parallelly, adjusted. So this is the balance sheet. So can you take down the balance sheet? Please take down the balance sheet. Have you copied the number? Have you copied? Okay, can I move on to the next part? So under certain assets and liabilities, there are few notes given. So can you take down the notes, please? Okay, so the questions, question number A, as the Chief Risk Officer of XYZ Bank, assess the implication of above monetary policy announcement will have on your bank and quantify the impact on net interest income. Now, if you are the Chief Risk Officer, now there's a monetary policy announcement coming. So you have to assess the impact of that policy announcement on your bank and quantify the impact on interest income. So that's the first part. The second part, in part A above, if the target cumulative gap ratio is 17% for a period of 1 year, what is your assessment on the above implication and what measures do you recommend to initiate to mitigate any such risk? So remember, we discussed cumulative gap ratio as a tool to benchmark. So if it is 17%, what is the impact arising from A if your benchmark is 17%? And what you recommend to mitigate such action, such risk? Third part, if the risk management committee of your bank has decided that bank will only adjust interest rate on liabilities by 50 basis points. Now, even though it says 75 basis points, you decide for the liabilities to adjust by only 50 basis points. What would be the implications on your bank, and justify your answer with appropriate calculations? So these are the three questions. So what you have to do, which model you are going to follow? Which model you are going to follow?
Repricing gap model.
Repricing gap model. So now answer the three questions using the repricing gap model. So to do that, what you have to do? Repricing gap model, what do you have to do? What you have to do? To do the repricing gap model, what you have to do? To answer that, you have to do certain things. What you have to do?
need to identify the buckets, that's maturity periods of the assets and liabilities. The first step.
Yeah, but yeah, maturity period is now we are talking about a 1 year time horizon. Okay, so 1 year time horizon, what you have to do? So maturity time horizon, we are looking at a 1 year. You see, what is the impact on 1 year? You know, so what you have to do? So how do you compute the repricing gap? To do that, what do you want to do? Our time horizon is 1 year. First step. What is the first step? How do you do it? To find the net impact, what you have to do? Your question is, this is the impact. So what do you need to do? Can someone tell? Alicia? Eurasia?
So identifying the the what to call this less than 1 year period assets and liabilities and putting into the formula?
Yeah, what assets and liabilities?
Sorry, sir.
What assets and liabilities?
So assets treasury bills 91 days. Then that is 25 million.
No, I'm asking a particular word.
Rate sensitive assets.
Okay, you have to find out what are the rate sensitive assets within a 1 year period. Okay,
Yes.
then you have to find out what are the rate sensitive liabilities within a 1 year period, and then you have to take the gap and apply the formula, right? So repricing gap formula, you have to identify what is rate sensitive. That means assets subject to repricing. What are rate sensitive liabilities? Liabilities subject to repricing. So first you have to work out those two. Okay, so everybody work out RSA over the next 1 year period and RSL over the next 1 year period. Then we can work out the gap. And then work out the impact on the net interest income as a result of upward policy announcement. So have you worked out RSA? Anyone? Sumatu, have you worked out the RSA? Anyone worked out or still doing? Vinali, have you done the rate sensitive assets and liabilities? No response. Lakshan, Mr. Lakshan?
Still calculations, sir.
Okay. This Tirukuma, Ms. Tirukuma? Sumutu? Taraka? Alicia?
Calculating, sir.
Okay. Alicia?
Still doing, sir.
Okay, okay. Udayana Patira? Okay. Okay. So once you finish, tell me the numbers.
So is it minus 125 negative gap?
Gap, give me a minute. No, how much you said?
Minus 125.
No.
That is
How much RSA you got?
175.
Something wrong there.
25. First one 25, the second one 75, and the 10-month one with note for 75.
Okay. So we'll discuss, but the answer is not again. Have a look at it again, but number is not right. So that's what I can say. So we'll wait for a couple of others to come up with the answers. Then we discuss.
Okay, so I'll go through the notes again.
Yeah, go through the notes and numbers again.
Yes, sir. Notes despite the maturity period. No, I'll go through the notes again.
Yeah, please check again. Probably then you will understand certain things you may have missed. But how much RSL you got?
RSA 175, RSL 300.
No, both are something wrong. Just check.
Okay, sir.
Okay. Maybe the rationale you thought maybe sometimes not right. So just check again, see whether you can think differently. Okay.
So can you please share the note 8, 9, 10? Because I was unable to write out.
Note 9 and 10.
8, 9, 10.
Okay. Yes.
Oh, after note 8. Okay, sir. Thank you, sir.
Okay. Anyone completed? RSA?
$435, sir.
RSA?
Yeah.
Not really. RSL?
260.
Oh, no. Anyone else got different numbers? Someone else got different numbers? Okay, let's go through. So start with the asset side. Okay, now the first asset, is it over the next 1 year period, the asset 1, treasury bill 91 days, is it a RSA item or no? Tell me. Is treasury bills 91 days, 25 million, is it a RSA or not over the next 1 year period? So you have already got some answers, so you can tell now. Is it a rate sensitive asset or no?
So I took it. Now I realize because it's maturing within 1 month period, it won't be affect to the rates, no? So that's initially I took it for the calculation, but it will be mature in 1 month period, so it won't be, the rates won't be effective.
Why?
Because only 1 month maturity is due, because maturity is due on
already there's a monetary policy announcement. Just announce. Huh?
Yes, got it.
So it is mature within a 1 year period. So isn't it subject to repricing? Huh?
No.
Why?
It's only 1 month period, so
yeah, 1 month. So 1 month is anyway within a 1 year period. So it's subject to repricing. The maturity will not be under the same rate which were originally invested, right?
Okay.
So anything either mature or subject to interest rate adjustment is subject to the repricing, isn't it? So first one is a repricing rate sensitive asset, because within that period the interest rates will go up and it is new cash flows will have to be invested in a new rate, isn't it? It's not the same rate which original treasury bills were invested. So the first one is a rate sensitive asset. The second one, anyway, it's again within a 1 year period, 365 days. So that anyway it is going to be, the bank has invested treasury bills in 15/7/2019. Okay, 15/7/2019. So again maturing within a 1 year period. So the second one also repricing asset. Second one, because that will mature on 15/7/2019 to 15/7/2020. 15/7/2020 is within the 1 year period we are talking of, from 30th June, right? Okay, so that is also subject to repricing. Treasury bond 175. The bank has invested in this treasury bonds on 1/4/2019 and have a maturity of 3 years. That means it mature on 2022 and also carrying 8% fixed coupon. So that is not subject to repricing, because anyway the maturity proceeds will you get after this period, and also interest rate is not repriced periodically. So that is not a repriced asset for our period. The short-term loan 75, that is maximum tenor 10 months granted at fixed rate. So anyway, that is going to be mature within our period, because 10 months means within a 1 year period. So that 75 also coming. So 25, 75, 75. Then long-term loans, not 5. The remaining maturity of these loans are in the range of 2 years to 5 years. So the remaining maturity is 2 years to 5 years. So anyway, it is beyond our period with quarterly interest payments. However, 75% of these loans are fixed rate, while balance 20% are variable rate. So there is no maturity problem, but repricing comes because of the variable rates. So out of this 120, 25% subject to repricing. That is 30. Out of this 120, 25% subject to repricing, right? Because that is variable interest rate. So the interest rate will be automatically adjusted, right? So there is a 30 out of 120 will be subject to repricing. That will come. Okay. Medium-term corporate bonds, note 6. The bank has invested them in 2019 and have maturity of 6 years. So definitely that is not going to come, and also fixed coupons. So that is not coming. Then long-term corporate bonds. So that is again with 10-year maturity. 10-year maturity with quarterly coupon. Okay, so that means how much? 50. That also subject to repricing. So that 50 also coming for repricing. The property is not there. So basically, assets subject to repricing 25, 75, this 75, 25% of this because of variable 30, and this 50. Clear? How much? 25, 75, 75, 30, and 50. So how much?
255.
255. Yeah, 255. Right. So you have to identify whether the within the period from today to 1 year, whether those assets will realize and will be priced at a higher rate, or I mean whatever higher or lower rate than what you have already invested, or any interest rate flow is subject to repricing. So those are the two key things in the repricing gap model. Okay. Okay. So if you go to the liability side, anyway, demand deposits, it's not interest rate sensitive. Then we have term deposits, 1, note 8. These are 2-year term deposits at an interest rate of 5%. So that means these will mature on 30th September 2020. So is 30th September 2020 within our purview? Is it within our purview?
Yes.
Yes, it is within the period 1 year from our date, balance sheet date. So that 110 is a rate sensitive liability. Then term deposit 2, note number 9. These are 3-year term deposits mobilized on 30th for 2020 with interest paid monthly at a 6% per annum. Is it under purview, our purview?
No.
No. Why? Because these are 3-year deposits maturing in 2023. Even though interest rate paid monthly at a fixed rate. So we are not worried about the change in interest rate because you have to pay 6%. So that is not part of rate sensitive liability. Okay. Then term deposit 3, 160, note number 10. These are 5-year term deposits mobilized on 1/1/2016 with the interest paid at 10% per annum at maturity. Is it subject to repricing?
Yes.
Yes. Why? Because those are maturing in 1/1/21. 1/1/21 within our horizon, repricing horizon. So that 160 would fall as a rate sensitive liability. Then term deposit 4, 180. Note number 11. These are 3-year term deposit mobilized on 15/4/20 with interest paid quarterly at STIBOR plus 2% per annum. Is it subject to repricing within our period?
No, sir.
No. Why?
Because it's matured in 5 years, it means 2023, and the coupon payment at annually, hope it will be fixed rate.
Coupon paid quarterly.
I'm mentioning about note 12.
Huh? Note number 11.
No, I'm mentioning about note 12.
No, note number 11. I am talking about note number 11.
Right.
This 180. Is it a repricing liability or not?
Yes, definitely, because you are paying quarterly at STIBOR plus 2%, the interest
So
rate.
that is a rate sensitive liability. So that's again part of our rate sensitive liabilities. The last one, debentures 50. So these are issued on 30/6/2018 with a maturity of 5 years and fixed coupon. So that is not part of rate sensitive liability. So we have 3 rate sensitive liabilities. We have already identified this 110, this 160, and this 180. How much total? How much the total?
350.
350, 110, 160, and 180.
450.
450. So we have rate sensitive liabilities over 1 year period 450. Rate sensitive assets how much?
255.
255. So what is the repricing gap?
Minus 190.
Minus 195. Okay, so what is the impact? Minus 195 times 0.0075, right? Because you have to apply for the formula. Okay, so if we apply the formula, so you have RSA 195, 255, RSL 450. So change in net interest income impact is equal 255 minus 450 into change in net interest. Change in interest rate. Change in interest rate is 0.75% upward positive. So that means decimal form 0.075, right? So that's come to negative 1.46 million, right? Clear? So the impact on the bank is the bank net interest income will decline by 1.46 million. Clear? Any questions? Okay, we'll go to the second part of the question. Second part of the question is, if the gap ratio is 17%, what is your assessment? Okay, if the target gap ratio, the bank target a 17% gap ratio, what is your assessment as a result of this impact? So the C gap equal minus 195 divided by the total assets. Total assets 610, right? So how much?
31.96.
31.96. So that means if your target is maximum, your variation is maximum 17%. If you have actual 31.96, that means you are above the target. So you are at a significant risk, right? You are at a significant risk. So what you have to do? What you have to do? There are several ways you can do. When you foresee this, you can either, now you have to reduce the gap, no? You have to reduce the gap. In order to reduce the gap, you have to adjust your assets and liabilities subject to repricing. That is rate sensitive assets and rate sensitive liabilities. So you can increase the rate sensitive assets. Then your gap will be narrower. Or you can reduce the rate sensitive liabilities, right? You can do it different way. Increase the issue certain debentures, increase long-term assets, and so on, practically. Or you can do a mix of, while you increase part of your rate-sensitive assets and reduce part of your interest rate liabilities, so that you can bring your gap within the target ratio. Clear? The last part of the question. Even though the increase is 0.75%, you decide that you will adjust the interest rate on liabilities by only 50 basis points. Then what is the implication? Okay. Then what is the implication? Remember, that is the both assets and liabilities are not adjusted same amount. So the change in net interest income equals 255 into 0.0075, because assets will increase by 0.75 minus liabilities 450 into 0.0050, because now it's different adjustments, right? So this will come to minus 0.3375. So your net interest income will decline by 0.3375 million, or roughly 337,000. Why? Because earlier both adjusted same amount, but now you decided you will not increase the deposit rate by the same amount. So your impact becomes lesser now, right? Can you see the board?
Yes, sir.
Okay. Are there any questions? Okay. So basically, now what you have to do is, if you get something like this, clearly identify what are the assets subject to repricing, what are the liabilities subject to repricing. That is very important. Okay. What assets subject? So repricing is through either maturities or interest rate adjustment. Okay. Idea is you may not get the same interest rate. Remember, refinancing gap and reinvestment gap. Remember, repricing come from those. We talk about refinancing risk and the reinvestment risk, right? In both sides. So once you identify that, put it into the very simple formula, repricing gap times the change in interest rate, and use the right sign. If it is increase, positive; if it is decrease, negative. Otherwise, you will end up with the wrong answer. The answer might be the right, but the number might be right, but you will interpret differently. If the things are different adjustments, then you have to apply separately the repricing gap. You have to take assets separately with the asset increase or decrease, liabilities separately with liabilities increase or liability interest rate increase or decrease. Okay, any more questions? So basically, those area now you must be thorough, should be able to work out any question. Don't tell you are not comfortable. I have done enough questions today, especially I did to ensure you are comfortable of any simulation, historical simulation. Of course, if it is Monte Carlo simulation, we have to run through your laptops. I don't know how practical, in time to come. If we have COVID-free, good environment, probably we can run something like that. But historical simulation, you can work out without any laptops. So you can work out any question like what we did, very simple, basic question. Then forward contract, anything on those areas, how to find out futures numbers, we have done enough. And repricing gap, duration, I didn't do any question today because we have done enough duration questions, duration hedging. So, and also asset and liability management, very basic things. Okay, so probably I will meet you again towards the latter part of the program with the parcel application and few of the other areas in the syllabus. Till then, probably you will have Mr. Fernando with you for the credit and credit and operational risk. Okay, so please revise what we have done. Don't wait till last minute. If you have any problems, give me a ring and clarify, so that you are comfortable with your, whatever, notes or whatever. Okay, so if you don't have, we'll conclude for the day.